Okay, now we are talking about exit strategies. Exit strategies, sorry, let me get this started. Exit strategies are options for entrepreneurs to finish or leave the business they start. Because just as people start business for a number of reasons, it doesn't necessarily mean that you have to be working with or in your own venture for the rest of your life. So exit strategies means the options that entrepreneurs have for leaving the ventures they create and the different ways of doing so. And this is important already at the start because an exit strategy is also of interest for an investor who wants to know where his money goes or their money goes. Just as they want to know when there is payback, whether they will be owning the company or partially owning the company for the rest of their lives, or whether there'll be a big payout at some stage. For example, a very common exit strategies is the so-called IPO, initial public offerings, which is when companies grow to a certain stage and then become publicly traded companies with stocks on the stock market. This is just one of the exit strategies. So let's have a look at them. So, as I said, investors will care very much about the exit strategy, and the business plan needs to spell out in how many years investors will be able to cash out in whatever form for the investment that you want from them. Yeah, and the financial data plan in your business plan must show exactly how we get there. Yeah, so it will not be enough to mention that someday the venture will go public and the company will be worth a lot and everyone gets a fair share. Um, Investors will know for sure exactly what type of payback and what sort of form it might be. And importantly, an initial public offering going onto the stock exchange is really only a realistic option for a very small number of startups. A different strategy for exiting might be that you are being acquired by larger companies. A lot of software, internet-based companies, startups are being bought by the big players, Microsoft, Google, Apple, and so forth. So here the exit strategy is not to go public, but rather to get a lump sum as a buyout. You know, think about WhatsApp or Skype being purchased by Microsoft, WhatsApp being purchased by Facebook for lots and lots of money. So different exit strategy. So there's obviously a number of them. Number one is, of course, you don't exit at all. Instead, you continue running your business, in fact, over many generations. So this is the classical model of the multi-generational, family-owned and operated business. And there's a lot of benefits here because it's a company that provides continued employment and wealth to an entrepreneur and his relatives and his offspring, right? And this is exactly what many German companies are known for, the Deutscher Mittelstand, Kleinunternehmertum, family-run business that have been in ownership by the same family for God knows how many generations. A very famous German example is Otto in Hamburg, which is still run by a member of the family who is the CEO. And it has been in this family for generations. And it's obviously not a small business anymore, but you get the point. Option two is again an exit strategy that doesn't really exit, but rather diversifies the business. So growth through diversification means that the company that started a particular product line in a particular market goes into different markets with different products. So we add products or service offerings beyond what we had as the initial or core product or service. We diversify operations, which means we can sell more, we can get more market share, etc. Yeah, so this could be an example for this is Amazon, who started as a online book retailer and diversified to include all sorts of other goods that can be traded online, and also to offering web services, Amazon Web Services, which is actually a bigger branch of Amazon than the original book retail business. A third option is that just like you can start a business by becoming a franchisee, you can exit a business by becoming a franchisor. So you can license your brand, your property, your idea, your business script to others to increase sales without you having to actually run the operations of all these stores. Yeah, so this is a type of a replication strategy. So a way for your business to obtain more money by letting others copy the script, the success formula for a fee. Yeah, so this is a growth strategy, especially if your business market is constricted by location. So you can sell in Cologne, but if you also wanted to do sell to the market in Munich, you'd literally have to go there. For example, in a burger shop. Then franchising and licensing is a good way of doing this. And there are, just like becoming a franchisee, there's also benefits and drawbacks to being a franchisor. The benefit is that you could grow with minimal capital investment, because the capital investment is actually taken, or being handled, or the responsibility by the franchisee that buys the license. So you can get royalties, yeah. So you can get a share of the profit that your franchisors make. These are the key benefits. Um, the drawbacks are that you include other people into your brand. So if your franchisees damage the reputation of the brand, of the trademark, and doesn't run the business in the way that you wanted it to be run, then that harnished reputation will also backfire on you. You need obviously qualified franchisees to operate your script, your business model in just the same way to be just as successful. And you can run into all sorts of legal or financial problems if you have franchisees that don't experience success, cannot pay the royalties or the licensing fees that you wanted them to pay. The fourth option, which is really the a true meaning of the word exit, are what's called harvesting and liquidation. Liquidation is the simplest form, which means you basically sell the entire business, all assets, concurrent with it being closed. So you close shop and sell everything that you have. Which, this is usually the option if there's no other way of continuing the business success and exiting at the same time. Because here we're not continuing with the business in any form, we're closing all the doors, which is typically the case if we don't make profit, if there's no success, and in fact all the debt and the costs are increasing. Yeah, in this case, then we close the business, liquidify all the assets that we still have at whatever price we can achieve for them. Or in fact, another way of liquidation is by declaring bankruptcy and losing everything. Usually we liquidate a business because otherwise we would just accrue more debt. If we were to accrue profit, then why would we liquidate the business? So we choose this option if all other options fail. A different strategy is what's called harvesting. Harvesting means reaping the benefits from a successful business, ideally as much as possible or as long as possible from how big an audience as possible. So harvesting means the act of selling, taking public, or merging a company to yield proceeds for the owners. So in liquidation, we are closing a business and basically try to cut our losses by minimizing the debt, by selling at least the assets that we purchased at some point. In harvesting, we're really talking about exiting the business and harvest as many of the profits or benefits that we possibly can. Licensing and franchising and diversification and continuing in the family are actually growth strategy, right? So we exit in the sense of that we may pass on ownership to our son or our daughter, or cousins or some other family member, or that we bring other people on board that diversify our business for other markets, or we bring franchisors on board who continue our operations in different places and locations. But if we really don't want to continue our business, then harvesting and exiting are the actual main, or harvesting is the main exit option. So what you need to remember here is that usually it takes a long time to build a company of sufficient value and success that it's possible or feasible to harvest anything. Yeah. So it's not a thing that we can do within a year or so, because otherwise everyone would do it, right? So we need to put in enough value add and enough success for having something to harvest. Yeah. The timing of harvesting is that if that is a strategy, then it needs to be part of the business plan as well, because it's important to investors. They want to know how their investment will eventually turn into cash or stock, or an ongoing royalty or a revenue stream, or just a lump sum, a buyout, so to speak. Yeah. There's basically 5 options here. for harvesting a running business. The obvious one is that we increase the free cash flow. Now, in the beginning years when we start and build a startup, then usually any profit that we make usually gets reinvested into the company to continue to grow. Yeah. So we want to reinvest as much profit as possible, and from these profits buy new infrastructures, hire more people, increase the marketing or whatever else we want to do. Usually we don't really have free cash flow, but at some stage it might be after 7 to 10 years we had do that and we continue to do this and there's still money left over. That's in the free cash flow, and that's literally the surplus that the owner then owns, right? So we retain ownership here. We don't have to seek a buyer. We are just, taking home the money that we don't need to run the business or even to grow the business. So we don't need to reinvest. Um, the disadvantage is, of course, we need to minimize taxes because these are then capital gains tax, right? So capital gains, so we're making money, and on these money earnings, we need to pay tax, obviously, which you don't have to when you reinvest. So because then you don't have actually any profits, any capital gains that you would then need to declare before your taxes. And of course, you have to be patient. It can take a long time because the growth imperative is usually more important than the cash flow, right? But after a while, and if it continues to go well, you accumulate income, of course. Extra income, I should say, because usually, obviously, as an owner, you also pay yourself a salary. The free cash flow is really anything that's left over after all the operating costs and all the reinvestment costs are paid out. The second harvesting strategy is what's called a management buyout. In this strategy, the entrepreneur, the owner and manager sells the firm to the other managers who can raise the money via personal investments and debt. So in other words, if I'm the owner and I'm owning my own company 100%, but I have a bunch of guys that work in my company as managers, I can offer them shares of my business to buy, and that's called the management buyout. That's very often the case. So managers often want to buy the business. Why would you want to manage a very successful business if there's also a chance of not only being a manager, an employee, but also part owner? And the other advantage is that usually you have people that are already employed as managers and already vested in the success of the company. So this is a common option. It's sort of like the stock market model, with the difference that it's not a publicly traded company, but a ownership or stocks of the company are being traded to a very handful select people. Say, you're 4 managing directors, or 3 or 2 or 4 or 5 or whatever. So you basically diversify and you get a lot of money for giving up some part of your shares of your own business. It typically means that if you are the manager interested in buying into a company, typically you have to get a loan, because these shares, depending on how successful the business is, can be quite expensive. So 5, 6, 7 figure lump sums. Yep. A variant of this is what's called the employee stock ownership plan, which is similar to the management buyout, but the difference here is that you not only open this possibility for managers, but to all employees. Yeah. So it allows the owners to sell their stock, sell their parts or shares of the company. And in case if you sell all the stock, then you're exiting the company. But instead of just offering it to managers, you're offering it to all employees. That is a part of what's called fringe benefits. Fringe benefits are basically like a salary payment that is not, part of a regular paycheck that you get every month, but you can get part of your salary in stock ownerships, right? So SAP runs this, for example. So it or Allianz and some other companies, they're offering the employees to buy part of the stocks. And if the company does well, the price for the stock will rise, and you get more money if you ever decide to sell your stocks. Yeah, and that has a couple of special tax advantages, because of the price that you invest in stocks, or the dividends that you get from the stocks. They are tax deductible, right? And of course, employees can be more committed to the company's success because they are part owners of the company. Yeah. Of course, if you give up shares, the stocks or shares of your company, then you're also giving up part of the control, because in a share owned or a stock owned company, the weight of the decisions is relative to the number of shares you own. And if, let's say, your company is 70% owned by the employees, then the employees have 70% of the votes in making any sorts of decisions. Yeah, and that's the same for the management buyout, of course. A fourth harvesting option, very different one, is to be merged or to be acquired. So we're selling our company to another company, either for as acquisition or merger, which means both of them come together. Yeah. So, and the acquiring company can realize growth that wasn't possible for you. Usually, it's a larger company that have more assets, more resources, or more cash, so they can take your business into just different markets because you can't build up the stocks and the resources that you need. And merge could be that, for example, if you merge with the competitors, then together you have a much stronger market position and you're unifying your isolated market shares. Yeah, that is usually a very lengthy strategy. It takes a lot of time to do this, to work out all the legal details of the merger or the acquisition. And that's a topic in itself, merger and acquisition. But for here, we just want to know that this option exists as an exit strategy. Right. And the fifth one, which is the most commonly known one, is what's called an IPO, an initial public offering, which is like the management buyout or the employee stock ownership program, with the difference that now we are selling shares of our company on the public stock market. Yeah, which means we go public and our company becomes a publicly listed company where anyone, an individual or another business, can buy shares of our company. That can be the most profitable way to harvest your companies, and the media is ripe with all these very famous IPO examples that raised a lot of money just on the initial day. And so it can bring significant financial rewards because the market may think that your business is so valuable that it pays a very large premium on your company's values. And we see this in the price of one share, yeah, being very, very high or rising, etc. But of course, it's very stressful, all consuming, and it, of course, can also backfire, because the market determines the outcome and the market determines the price for every stock. Yeah. And of course, just with management buyout and employee stock ownership, you're giving up control of your company, in this case to the public. Whoever owns the most shares has the most say in your company. And if that happens to be a competitor or someone that wants to realize a different strategy, then there's literally nothing you can do about it. Yeah. But of course, the potential for an enormous payout is the biggest in this option. And that's it. These are the different exit strategies that are available to new ventures. And as you can see, they all have a variety of different advantages and disadvantages.